want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to the DIY Investing Podcast. My name is Trey Henninger and I'm your host. Be sure to subscribe to the podcast to get more great investing content. If you're listening on YouTube, hit that like button on this video. And any other platform, your 5-star rating and review are a great way to support the show. Thank you for your support. Today's episode, I believe, will be slightly shorter than normal, but I've said that before, so we shall see. But today we are focusing on an investing rule. I've done these episodes before. Basically, an investing rule is a simple and short rule that limits your mistakes or improves your future performance or returns by focusing your process. And so that's what we're doing today. We're talking about another investing rule, and I think this is a very strong investing rule that I think basically everyone could benefit from adopting. And today's investing rule is super quick, super simple. Never short stocks. You see, shorting stocks is stupid. And there's a lot of examples that we could go into, and I'm not going to go into them all today, but I will touch on a couple further down in the podcast. But what I want to really center your thinking on here today is this quote. I don't know if I've kind of paraphrased it myself. I don't know if I created it myself. I certainly know that it draws heavily on the teachings of Charlie Munger, Warren Buffett, and many other investors. But basically, it's this phrasing. You don't need to be smart to make money investing. You just need to be consistently not stupid. You don't need to be smart to make money investing. You just need to be consistently not stupid. And so that's really the framework for today. That's really the framework for investing rules in general. We're not trying to be smart. We're not trying to make the best decisions possible. We're just trying to avoid making bad decisions. Shorting is a bad decision. So why is shorting a bad decision? Well, shorting is a bad decision because when you short stocks, everyone wants you to fail. Everyone is working for you to fail. Everyone is working to make you lose money. And I'm not just talking about people in the market. I'm talking about everyone that works at that company is working 8-hour days, 9-hour days, 10-hour days, 12-hour days, 5 days a week, at some companies 7 days a week, trying to make you lose money. If you're shorting a company that has 1,000 employees, that is 1,000 people working to make you lose money. If they have 100,000 employees, that is 100,000 people doing everything they can to make you lose money. This is the definition of stupid. What you're doing is you're setting yourself up to fail because there are so many things out there fighting against you. All the employees, all the executives want you to lose money because they are working hard to do their jobs. They're working hard to have the company make money. Even beyond the company, you have local governments, local organizations that want to have employment. So if a company is going towards bankruptcy, they're going to do stuff to help save it. They might pass laws. They might give subsidies. They might give regulations that are favorable. They might pass stimulus measures, doing anything and everything to help those companies survive, help those companies make money in an environment that you thought they could not do. The key here is that there's so many people fighting against you to lose. Not only that, in our case studies today, we're going to talk about GameStop and AMC. And these case studies highlight one of the risks of shorting is that it's not just the people in the company, it's not just the people outside the company, it's also the people in the market that are working against you. People can band together and focus on squeezing a stock that's completely irrelevant from fundamentals and can cause you to lose money. So with shorting, you can lose money because the fundamentals go against you. In shorting, you can lose money due to random chance with the random walk in the stock market. In shorting, you can lose money because of non-fundamental reasons where people are buying a stock simply for speculative reasons. There's all sorts of ways you can lose money with shorting, but it's not just that. Shorting is stupid because it has unlimited downside and limited upside. If you're right, if everything goes how you expect with shorting, what does that mean? At max, you can make 100% on your money. If you short a stock at $100 and it goes bankrupt and goes to zero, you can only make $100 per share that you short. But if you're long a stock at $100, it could go not just to $200, it could go to $500, $1,000, it could go to $1 million. Your upside is unlimited and your downside is limited. But with shorting, it's all flipped. You have unlimited downside and very limited upside. So it's not that you have asymmetric risk reward positively, you have asymmetric risk reward in a negative manner. You can lose unlimited money shorting. That's the definition of stupid. You never want to take a risk, ever, that has the risk of throwing a zero into your portfolio. What happens with compound interest, what happens with compounding is what you're doing is you're multiplying gains over and over year after year. So if you have a 10% gain this year and a 10% gain next year and a 10% gain the year after that, after 7 years, your 10% compounded equals 100% growth, even though 10% on a arithmetic average would only be 70% growth. And that extra 30% came from compound interest. Because what's happening is you're multiplying 1.1, which is 1 plus 10%, over and over and over again, and that compounding is what allows things to grow faster over time. Well, what's the difference here? Well, the difference is if you multiply any number by zero, it always equals zero. So you could have grown from a 10% growth for 10, 15, 20, 30 years, but if you multiply by zero at the end, it wipes out your entire portfolio. It can wipe out everything. And that's the risk that you have with margin risk. That's the risk that you have when you're making these bets. There's asymmetric risk. You can lose everything you have when you short. You can lose your house. You can lose your car. A lot of people, when they go bankrupt, lose their marriage. Some people, there are instances of people that have shorted or people that have taken risks like this who end up sadly committing suicide. There's all sorts of risks associated with shorting stocks. These are risks you should never take. Just like you would never play Russian roulette, you should never, ever short stocks. It's a very simple rule that can save you from some devastating mistakes. And it's not like the upside here is great. The upside is limited. You have limited upside, but unlimited downside. This is the definition of stupid. So let's cover a few examples here today. So the first case study for us to talk about today is GameStop. GameStop, I'm recording this in February 2021, and we have just completed a massive, epic short squeeze in GameStop, which occurred in January of 2021. And the impacts here are far-reaching. We still don't know everything around it. And I think this is going to be studied in some respects for quite a long time, but it really isn't a huge deal at the end of the day. But what it does highlight and what it is useful for is it can always be used now as an example for why shorting is stupid. So, if you haven't heard of the GameStop short squeeze and you're an investor, you've probably been living under a rock, or you've done the right thing and you've insulated yourself from noise in the market. So that's a very positive thing. This is not a negative thing. I think every minute you spent thinking about GameStop was probably a minute wasted, but hopefully I can not waste those 2 or 3 minutes while I cover this case study. So GameStop stock was trading at $15 to $20 per share when the year of 2020 ended, and that was its trading range, somewhere between $10 and $20 towards the end of year. By the end of January, so if we look at January 27th, the GameStop stock price hit a high of $380 per share, which represents a gain of almost 20x from where it was trading at the end of the year. And it hit a high in the 400s on January 29th. These are intraday highs. And then on intraday high of January 28th, had a high of 483, which I think was the all-time high. I'm not 100% sure. But at 483, you're talking 26, 25x higher in price than the stock was trading at the very beginning of the year. So this is a stock that went up 25x. The fundamentals did not support the stock going up 25x. And the reason for it was shorting. The stock had a short interest of 140%. What this means is if there were 100 million shares outstanding issued by the company, at the time that this stock squeeze began, with 140% short interest, it meant that 240 million shares were held by people in brokerage accounts. So only 100 million shares exist, but 240 million shares are held by people in brokerage accounts because there's 140 that have been borrowed and sold to people without them actually existing. So what happens is people realize this. They got together on Reddit and said, hey, the hedge funds screwed up. They sold short this stock, more shares than exist. All we have to do is buy enough of it, and we can name our price. And they're going to have to buy it from us at vastly inflated prices. Well, it worked. They bought a ton of call options. They bought a ton of stock, and they forced the stock price to rise from the $20 price range into the $400 price range, causing a 20x rise in prices and billions of dollars in losses to the hedge funds and anyone else who was short GameStop stock during this time. Now, you might say GameStop stock was not inherently a bad pick as a short. This is a stock that, the company is in terminal decline. They've been losing money for a couple years, and it's pretty reasonable to expect they will lose money every year into the future until they go bankrupt. But they're not bankrupt yet, and even if they will eventually go bankrupt, you can lose all your money in the interim. And it can be for completely non-fundamental reasons, and GameStop is a great highlight for it. I'm not going to give an all-exhaustive account of GameStop. You can find hours and hours and hours of content about that around if that is of interest to you. But I think it would be a waste of your time to go into it any further. But what is valuable is to talk about another case study of just another example of this. So AMC stock is the movie theater. AMC Theaters in the United States was also participating in a short squeeze in 2021 around this time. I don't even know if I'd call it a short squeeze so much as just a massive long squeeze from investors. And what happened was these same Reddit investors, after making money on GameStop, turned to find other stocks in which to do this same playbook, and they chose AMC as one of their targets. AMC was almost universally considered likely to declare bankruptcy early in 2021. At the end of the year, it was highly likely to declare bankruptcy. They did not have enough money to stay open for the rest of the year, and they faced imminent bankruptcy from their debt holders if they couldn't raise new debt or new equity. So they either faced bankruptcy or massive dilution from the stock price at a $1, $2 range, creating hundreds of millions of new shares. Well, what actually happened is that AMC stock was targeted by these short squeeze targets, and it caused the stock to rise 5, 10x very, very quickly in market cap because it was quickly bought by massive numbers of retail traders and many other traders trying to get in on this squeeze that was happening. But the company is still basically doomed, although this one is slightly interesting because it's very different than GameStop. GameStop didn't issue any shares during the short squeeze, but AMC did repeatedly. throughout January and February, they have repeatedly issued new shares to those masses who are willing to buy them. And what they've been able to do is shore up their balance sheet to the tune of hundreds of millions of dollars due to new share issuance. I believe the shares outstanding have doubled or tripled so far in 2021. And what this has caused is it caused the business fundamentals to improve drastically, because now the business balance sheet has a lot of cash, which they can use to pay to keep their employees paid and pay all their rent expenses throughout 2021. Which they had no prospect of doing. So why do I bring up AMC? It's not simply because it was targeted for a squeeze by the Reddit investors, but I actually think it's interesting because I entered into a contest online for a long short stock choice contest for 2021. And I don't short stocks, but you had to submit both a long and a short. And so when I was doing research during the December, you had to submit your pick by December 31st of 2020. I was like, I don't short stocks. So how in the world do you choose a stock to short? And I was like, well, the only thing that could ever make sense would be a company that was doomed to bankruptcy, a company which was so highly likely to go bankrupt. Not just like sometime in the future, but sometime in the next 30 days. So from all my research, I was like, AMC looks like they're going to go bankrupt sometime in the next 30 days, unless they pull cash. And if they do get cash, it's going to dilute shareholders so much that the stock price is going to drop enough. So even if they don't go bankrupt, you should still make money from that pick. So I didn't put any money into this short, but again, it was just a paper traded stock choice. And so I was like, well, AMC is my short. So I chose AMC because I thought they were going to go bankruptcy. And guess what? They didn't, because of something I could not have predicted. You can't predict these things. And it's just another example of you cannot predict the future. It's impossible. So if you are going to invest, you need to make sure you're investing in scenarios where there's unlimited upside and very limited downside, and avoid scenarios like shorting with unlimited downside and limited upside. Because although you can't predict the future, you can align the probabilities in a way that leads to disproportionate payoff for you if you're right. You're going to be wrong sometimes, and you want to avoid losses when you're wrong, and you want to make massive upside when you're right. And so that's how you should structure your portfolio. But it's also why you should never short stocks. Again, I began this episode with the idea you don't need to be smart to make money investing. You just need to be consistently not stupid. If you're consistently not stupid, you can become very, very wealthy over the course of years and decades simply by investing in the stock market. Just don't do stupid stuff. And shorting stocks is stupid. So I highly encourage you, if you're a listener to this podcast, if you want to learn something that improves your investing process, do not short stocks. The upside is limited. The downside is unlimited. And it's not simply the portfolio impacts. The psychological impacts are massive. You're going to spend more time thinking about your shorts than you do your longs. The shorts are further outside your portfolio, your control than your longs, and they open you up to margin calls, which could completely wipe out your portfolio. So, my investment rule for you today: never, ever short stocks. Thank you for listening to today's podcast. The full show notes for this episode, including my outline, will be available at DIYinvesting.org/episode 111. Please remember this is a listener-supported podcast. If you've gained value from today's content, please consider supporting the show financially as a patron. I produce 4 to 5 episodes a month, and you can support the show at a price as low as $5 a month or $1 per episode. That would be incredibly helpful to me to continue supporting the podcast. You can find out that information at DIYinvesting.org/patron. Thank you for listening, and until next time, stop paying fees, start building wealth.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.